Joining us now to discuss all of this, Joel Shulman, David Dietz, Susan Lee. Joel, first I want to talk to you about this morning's GDP number. Right. All right, 2.1%. The consensus was 1.8%. But some people were thinking of 1.3%. So this is certainly better than anyone anticipated.
Yeah, and what's particularly interesting about this is the consumer discretionary spending's up. It was it came in at 4.3% growth. They're expecting a little bit lower. Many expect the consumer discretionary now to carry us through the year. So with trade being off with the China trade war, we're really looking at consumer discretionary, and of course, tech continues to carry the ball for large cap companies.
Inventory is down $44 billion, so that was an adjustment to the first quarter. That's going to probably be a little bit better in the incoming quarters also.
Yeah, that's right. So with the inventory down a little bit, it was a blip from period to period. But again, we should see consumer discretionary carrying. Interest rates are low. They'll probably continue to go down next week. We should find out soon.
David, does this change your thinking on the Fed?
No, that's why I think it's almost a Goldilocks number, because it's not so strong as to cause the Fed to change from its basically dovish tilt here. And I thought the numbers were very good, given all the headwinds that are actually external to our country. For example, the weak overseas economies. For example, the dollar continuing to move up, which puts a headwind into the exporters. So I basically liked it. And also, when you look at the comparisons versus last year was the first year of the tax cuts. That made the comparisons more difficult. I like this number.
Now, finalized data shows that 2018 didn't grow at 3%, but when you couple so far 2019, the first quarter, despite the longest government shutdown in history, saw almost 3% growth. You're adding to 2.5 almost in the second quarter. I think people are taking a step back. Yes, it's baked in. We'll get an interest rate cut next week, but to 2 or 3, some are saying that's going to be a little bit hard. There's a high hurdle to cross at this point.
All right, let's talk about some strong numbers also on the earnings front. Google, David, Google, Wall Street loves what they have to say. Their traffic acquisition costs were a little bit less, and it's apparent that these other businesses are really starting to do well. They're telling us more and more about them. So obviously, the YouTube and search and some of these other things are doing pretty good here. Would you buy the stock at the open?
We were buying it yesterday.
Yeah, I know you're in it, but like for the viewer who didn't catch you on my show saying buy this stock.
Well, I think of all the FANGs, Google's probably the one to buy because it's the most reasonably priced, and I think they still have a lock on the display advertising with their search. YouTube is coming along quite nicely, and now, of course, to the extent that they're sharing more about what the drivers are behind their business, a lot of combination, a lot of synergy there. And finally, they announced a $25 billion stock buyback. Yeah. So if they're buying back their stock, that's a good cue for the average investor.
The irony, of course, Joel, is that lock on search, maybe 95%, is one of the reasons why they can't get outside of the scope of government, this government looking at them closer and closer. Right. Many say of all of these big tech names that D.C. are concerned about, maybe this is the one that gets broken up.
Yeah, I'm not as concerned. I mean, this is a great company. Of course, they'll always have considerations on antitrust, but this is an entrepreneurial company. They're growing across the board, lots of areas, 16% up on ad click revenue, which overall for a $39 billion revenue company is impressive. When you look at their stock, the earnings per share going from expected 11.3 to 14.2. This is just very impressive growth, and 40% growth across the board on areas that are not ad revenue click based. This is a company that's investing a lot in R&D. They're creating a lot of jobs for the country. So if people are looking at them from an antitrust standpoint, they've got to remember companies like this are growing jobs by about 15% per year. This is a company that's driving the growth. This is a great entrepreneurial company that we strongly believe in and is helping Americans and people around the world.
Yeah, it's a great quarter, given that this is the quarter also where they accounted for that $5 billion European Union fine as well. But I think there's a lot of concerns in terms of growth in paid clicks decelerating for a second straight quarter, and the growth rates were not at what they used to be at 50-60%. Yes, a lot of people would take around 30% growth, but when you're looking at a saturated advertising market online, especially one that Google dominates, some are saying, where's the next leg up going to come from?
Well, so to that point, they had revenues increased by run rate $8 billion in the cloud, and so this is a company just like Microsoft.
Yeah, they broke out the cloud number, right? So and that was a big number, $6 billion. And ready to go higher. Speaking of cloud, let's talk about Amazon for a moment, folks, because the online retail giant, they had record profit streak come to an end. Here's the thing, Joel. You just talked about how much the Google is helping society. Yeah. Amazon says they're going to triple their workforce, their sales force, in the next 3 years. And all they talked about was investing. I mean, this is huge.
Well, R&D's been up 26% for the last year. They had, in 2013, 117,000 jobs. Right now, they have 647,000 jobs. So in about 5 years. So this is the fastest growing company in terms of employees. In fact, if you look at the entrepreneurial companies, particularly in tech, which we're going to now break out separately, when you look at the tech companies and the entrepreneurial companies, almost all the growth in jobs are from about 30 companies in the S&P 500. And so this is a company, now AWS has dropped from about 10%, they've grown from 10% to 12%, and their profits have come down.
And there's more competition for AWS that we're seeing, because Google broke it out, and we know, of course, and Microsoft.
I want to talk about the cloud for a bit, because, AWS had a 6-year head start ahead of Microsoft, ahead of Google, and for the quarter, they made $8 billion. That's a run rate of 37%. This is a company on its own that's worth around $30 billion with an annual run rate on average of 40%. So there's some concern of a slowdown in AWS given their dominance.
Well, hold on. So let me bring David in, because, listen, we know it's going to be more crowded and perhaps it will slow down. But the idea, though, is the cloud itself has so much more to grow that there's room for more than 2 players, perhaps. Maybe there could be 3 giants in there.
Yeah, absolutely. Of course, at one point, AWS had it by itself. And now, of course, we had very strong cloud results from Microsoft. IBM just bought Red Hat. Google just stole a key employee from Oracle. So there's a lot of pressure there. I think that's the one concern, because so much of the profits is coming for Amazon from AWS. That's the golden goose, which has allowed them to do so much in terms of their retail.
Well, to this point, I mean, the last year, the revenues were 10% from AWS. Profits were 75%. This year's 12% of the revenues AWS, 50% of the profits. So the profit price is coming down. Salesforce, by the way, is another player in the cloud space. So there are a lot of players.
But let's get back to what consumers understand about Amazon, which is buying and also getting that one-day shipment now if you're a Prime member. And I believe that shipment costs actually bit into the bottom line. They jumped some 35%.
That's why the argument now shifts back to the argument that it was for Amazon for a decade. Forget about the bottom line. This is a company that's building for dominance. They're going to spend $9 billion. They spent $9 billion on technology and content, up 25%. Fulfillment, which you're talking about, over $9 billion, up 17%. Marketing, up almost 50%.
And getting to
so they're going
Prime.
after that consumer. Let's check. Let's broaden out the conversation here a little bit, folks. Check on the big board. We're a little bit, we're just sort of feeling our way around right now. Let's talk about some of these other names, because Twitter's revenue, they beat the street, and then we had a really strong, rosy forecast from Starbucks. Twitter, the guidance was so-so, but everything else was phenomenal.
5 million new users, high growth, is best growth they've had in years in terms of acquisition. I think it's about 3 years. Biggest number of users increase. So 5 million new users.
Monetized daily active users up 14%, 139 million. Twitter trying to break out through $40 this morning. Starbucks had a good number. McDonald's had a mind-boggling number. So it's just more than these names that we talk about often, David.
So, the profits recession was much exaggerated, and despite all the concerns about the trade war tiffs, about the higher dollar, we're seeing some of America's greatest companies just powering right through it. They're cautious looking forward, but how can you not be cautious?
Charles, one point on McDonald's. Revenues in the last 5 years have dropped about 30%, but profit margins have increased by 13%. So this is a company, I haven't been to McDonald's in a while, but apparently the burgers are now more expensive. They are making more money on less revenue than they did 5 years ago.
They're getting rid of that cheap stuff. They really are getting rid of the cheap stuff. And you know what? You know what's making it work? Service.
But also
service is making it work.
Giving cash back to shareholders. There was $100 billion cash back in buybacks and dividend boosts over the last few years. That helped the stock.
By the way, people should know, comp store sales in America were 5.7%. The Street was looking for 4.5%. International, 6.5%. Wall Street was looking for 5.1%. That's why McDonald's is surging. Guys, thank you all, and gal. Thank you all very, very much.